Very good evening, investor. It's Ashish Dhondge from Envest Market, and I'm here to tell you about what are derivatives in trading. In this video, we are going to know about what are derivatives and their types. So basically, derivative is a derived value from an underlying asset. It means that if the underlying asset increases, the derivative increases. A very simple concept. For an example, if we take a gold derivative, the gold derivative will increase only if the gold prices increase. Now we'll take an example from share market. If a share price of a particular company increases, automatically this derivative of that company will increase. And now the derivatives are divided into four parts. It's forward, futures, options and swaps. Forward and swaps are not included in trading. In this video, we'll learn about futures and options, which are known as F&O. Now we'll see what are these futures and option and how is trading done with these terms. So basically, if you want to buy a future or an option of a share of a company, you cannot buy it with one share. You have to buy a whole share lot as per the company has decided. For an example, if you want to buy an option of an XYZ company who has decided a lot of 500 shares. Assume that you want to buy a share of company whose share price is 5,000 rupees and the company has decided the share lot of 500 shares. Now just imagine what will be the final calculation. 5,000 into 500, it will be 25 lakh. Are you able to pay this 25 lakh? Not only you, but none of us is able to pay this much amount. So now if I say you just have to pay a 2% of this price and you will get a token for that share. Will it be more interesting? Yes, it is. You don't have to pay this 25 lakh. You just have to pay a 2% or 3% of that share price. So now we'll see how this derivative works. The derivatives have two simple terms. It's a buy and sell. Okay. If you want to sell, it is called as short sell. It means to sell first and then buy. If you have a technical analysis of a particular company, you are guaranteed with this that this share will fall down. So you sell the share first and then you will buy. When it will come down, then you will buy. Make it easier to buy at low price and to sell at high price. It makes a profit. Or to sell at more price and to buy at low price. It makes a profit. Okay, now you understand what is short sell. You can sell first and then you can buy. It also continues with buy. If you have a technical analysis of this company will get high or it will gain a share price, then you can buy at less and you can share at more. For an example, if you have a technical analysis of a particular share whose share price is 1,000 rupees and you know that it will fall, so you make a call for buy. You sell the share at 1,000 rupees and you will wait till the share comes down. As the share comes down, you will buy the share. So the 1,000 and assume that its share comes up to 800. 1,000 and 800 between 200 rupees is yours. Okay, the concept is clear. So now this trading has a specific time. It has a specific period which is divided into three phases: 1 month, 2 month and 3 month. They are also known as near month, next month and far month. Now we'll see what are actually options and futures. Options is an contract that conveys the shareholder the right but not an obligation to buy or sell. What is this obligation? Obligation is mean compulsion, mandatory. For an example, if you paid a token amount for Reliance Industries and made a buy call for Reliance, you paid a token amount something, assume that you made a token amount of 200 rupees and now the share price is 2,000 and you're making a call that this share price will go up. You buy it at 2,000 and if the share price goes up, you make a profit. Vice versa, if the share price goes down, you don't make a loss of 2,000 or anything. You make a loss of your premium amount you paid for the token, which was 200 rupees. This is the advantage for option traders. They can cancel the contract anytime. Now in futures are, it's a contract that conveys the shareholder the right to buy or sell with an obligation. This means that if you make a buy call for a particular company, assume that it's Reliance, you made a buy call on 2,000 rupees and if the share goes up, you will get the profit. But if the share goes down, you will make a loss for this 2,000 rupees. Your premium amount will also go and your loss will also go. These are the basic concepts of options and trading. I know it's very deep for option and trading. If you want more information for option and trading, comment below and let me know. I'll definitely make a separate video on options and futures.
And don't forget to subscribe our channel for daily share market updates.